Hello and welcome to this special report here at XM.com. We'll be taking a look at gold and how rate cut expectations and geopolitics could impact its performance going forward. I'm Maria Bashir-Davis, and joining me is lead investment analyst Rafi Boyadjian. So Rafi, since 2020, gold has been repeatedly setting record highs. Can you tell us why the precious metal has seen such a surge in popularity over the past few years?
Well, indeed, Maria, gold has been setting record highs repeatedly in the last few years, and the main reason for that is because the world has been going from one crisis to another. Of course, back in 2020, that's when the pandemic started. That's when we saw gold prices hit the $2,000 mark for the very first time, and then once the pandemic started to subside, we had the onset of the Ukraine-Russia conflict. So then we saw gold prices scale fresh heights, and then even last year we had the mini banking crisis in the US that also boosted demand for safe havens, and that's what it comes down to really, is because gold is a traditional safe haven. It remains one of the most popular safe havens to this day, and on top of that we've had some other factors additionally boosting gold prices. Namely, we've had central banks really kind of stepping up their purchases of gold to basically boost their gold reserves. This trend has been primarily led by China, and the reason for that is because countries like China, they want to move away from the reliance on the US dollar, a process that we call de-dollarization. So by basically having bulk of their central bank reserves in gold rather than the US dollars, they're kind of immune to anything related to the US economy or any sanctions by US authorities and so on. So that's one of the reasons why gold really has had such an exceptional time in the last few years.
So do you think gold's uptrend will continue now in 2024?
Well, indeed, that appears to be the case, at least, at the start of the year. Central banks will probably continue to buy more gold in the next few months at least. And then also the geopolitical risks, they showing no sign of de-escalating. We still have the war going on in Ukraine. Maybe that's something that potentially we might see a move towards peace talks later in the year, but it's too early for that right now. And then, of course, more recently we've had an escalation in the Middle East, and it's not just the war, the Israel-Gaza war. Now we've got, of course, the crisis in the Red Sea. So all of this can impact financial markets in many different forms. So that's why we still have this ongoing risk premium that's kind of supporting gold, underlying the bullish case for the precious metal.
And finally, what are the risks for gold going forward? What should traders look out for?
Well, one of the things that had been acting against gold prices, which kind of goes contrary to this sort of negative correlation between gold and interest rates, or gold and bond yields, particularly US bond yields, is the fact that when bond yields and the dollar go up, gold is supposed to go down. But we haven't seen that. And of course, in the last 2 years, we've seen a huge rally in the US dollar. We've seen a huge rally globally in government bond yields because, of course, we've had this inflation problem, and to fight inflation, central banks have to raise interest rates. So gold really should have been going down, but instead, of course, gold had support from all the other factors that I mentioned earlier. But in 2024, it is expected that central banks will start to cut rates, and then should they do that, because of course we have inflation under control now, so should we begin to see that, then we should see gold prices getting an additional boost from this, because low yields, a weaker dollar are positive for gold. So this was one of the sort of things working against gold, but now it's expected to, of course, work in favor of gold. The risk, though, is that maybe central banks might not cut interest rates as much as possible. So should markets start to price their expected rate cuts for the Fed, for example, then we might see gold prices coming under pressure. We might not see all these rate cuts materialize, and that could be negative for gold. And of course, we have the overall threat that inflation globally might prove to be stickier than anticipated in general. So that also means globally, other central banks also don't cut as much as expected. But on the other side, of course, we've got the possibility of worsening of the situation in the Middle East that would really boost gold prices. We have, of course, always the threat of potentially the invasion of Taiwan by China, an escalation in the Korean Peninsula, and so on. And then there's also the possibility that the US dollar might weaken, even if we were not to get the expected number of rate cuts. Maybe other economies will start to improve. For example, if China, we see a strong recovery there, that boosts European growth. And then if other economies are doing well, then there's going to be less of a case for a stronger US dollar. And so should we start to see the dollar weaken on driven by factors other than interest rate outlook for the Fed, then that would also potentially weaker dollar would be positive for gold. So we have both upside and downside risks.
Rafi, thanks so much. And thanks for joining us for this special report here at XM.com.